Hello, everyone, and welcome back to the podcast. Today, I'm going to be analyzing Netflix, which to date is a 460x stock since its IPO. And what's really interesting is that just over a year ago, the market gave up on this company. Since the stock is up 200%. So, in this deep dive, we're going to find out why. And let me just take you back in time. I wrote my original Netflix deep dive in March 2023, just as the market had turned highly pessimistic on the stock. In the deep dive, I highlight how actually Netflix should not be analyzed as a streaming company. At a fundamental level, it's a rapidly evolving entertainment company with a vast runway ahead. In late 2022, the market, as I was saying, was spooked by Netflix's slowing member growth, which it attributed to increased levels of competition, and actually not wrongly so. Netflix was no longer alone in the quote-unquote streaming business, and so the stock lost its charm. What particularly caught my attention is that this narrative not only sent the stock down over 70% from all-time highs, but also had great investors like Bill Ackman that I look up to capitulating. However, as I was saying, Netflix stock is now up over 200% from the lows, with the company's fundamentals back on track. So it begs the question, what happened? In my original deep dive, I focus on what made Netflix a 300x stock since its IPO, which is, for those of you that don't know, the initial public offering. Then I pinpoint why investors jettisoned the opportunity to continue compounding capital at a fantastic rate. After all, Netflix is now a 460x stock with the potential to grow more than tenfold from here. My view is that in 2022, many Netflix investors simply didn't know what they owned. As I argue in my original Netflix deep dive, streaming platforms are merely the contemporaneous manifestation of what we have traditionally termed as entertainment companies. They are the combination of an intellectual property and distribution engine, which then combine to deliver entertainment at scale. This machine has many parts, and incremental efficiency improvements compound to yield competitive advantages. The reward of wielding a world-class intellectual property and distribution machine is ultimately scale. Producing intellectual property and distributing it successfully is a risky endeavor. Economies of scale mitigate the financial risk because scale yields asymmetry by maximizing wins and minimizing losses. Movies and shows are produced locally, relatively speaking, with people working in a specific or few specific geographic areas. They may even cater to the local culture to optimize initial releases. If the distributed product is bad, it then goes on to be a local failure and people forget. But global success proliferates the gains by surging beyond fixed costs. Scale also generates data, which allows AI models to be trained to predict what audience will like what content. The more and higher quality data the machine accesses, therefore the more efficiently it will be able to match fans with intellectual property, which over time equates again to more scale. As AI keeps improving, the strength and relevance of this moat will increase exponentially. Thus, the core driver behind Netflix's 460x return since IPO to date is actually the company's prodigious ability to fine-tune the machine. And this is what investors didn't understand in 2022. The machine is fundamentally driven by Netflix's culture in turn. And the second driver is Netflix's ability to allocate capital resulting from scale to then accelerate iteration. The combination yields a flywheel that has actually proven to be very hard to replicate, even though everyone thought in 2022 that Netflix's competitors were going to be able to do just that. Qualitatively speaking, Netflix's productions are suddenly relevant again. I very much enjoyed the series The Gentleman, for example. I remained worried in early 2023 about the difficulty of maintaining this flywheel, but during my research, I noted that when Netflix decided to go global in 2016, its operating margin was 4%. Today, the trailing 12-month operating margin is over 22%, while the competition continues to struggle to turn a profit. The trend is indicative of Netflix's unusually efficient ability to produce cultural asymmetries, which in effect are the core of its business. Netflix can repeatedly move into a different culture and produce local hits that go viral worldwide. We now have the benefit of hindsight in the analysis, but it seems that Netflix's machine is simply superior to that of competitors. Netflix is constantly iterating both its intellectual property and distribution engines. They have ups and downs, but over the long term, they trend up and to the right. Further, every once in a while, Netflix makes a longer iterative step, which seems more discontiguous in nature. For example, Netflix became known as a quote-unquote streaming company because of a strategic decision to transition from renting out DVDs to enabling people to watch them online. Faced with increased competition in 2022, Netflix decided to gradually phase out its entry-level subscription and, funnel those customers into advertising plans. According to management, the ad-based business model has better unit economics than the traditional subscription format. Strategically, however, the shift makes particular sense as consumers have more choices and are thus more reluctant to pay. What's interesting is that the market saw this move as a sign of weakness and further justification for the narrative surrounding increased competition. The market wrongly interpreted the core value drivers of the business. This is why I was saying that investors in 2022, Netflix investors, simply didn't know what they owned. In reality, the shift to ads made the barrier to entry for competitors higher. Getting the intellectual property and distribution flywheel right at scale is hard via subscriptions, but it's even harder to do so while building out an ad tech stack. I believe this step will actually help Netflix sharpen its edge over competitors in the coming years, making it harder for them to attain the same level of capital efficiency. What Netflix must do to continue succeeding is unknown. However, the company has demonstrated that in its present form it can be relied on to execute as required. It also helps to understand the business at its core in order to evaluate management's decisions, which is why I and we do deep dives in the first place. At its core, Netflix is a learning machine with high levels of customer centricity, together with other highly desirable cultural properties that I talk about in my original Netflix deep dive, which you can find for free in my blog. Each challenge that Netflix successfully confronts, i.e. distribution and intellectual property, helps the company then address subsequent battles. This quote from co-CEO Greg Peters in the Q1 2024 earnings call shed some light on how Netflix goes about iterating its machine. He said, and I would say we're generally taking our entire playbook, everything that we've learned about how do you grow members, and we're applying it to our ads tier now. It's very interesting to analyze what investors got wrong in 2022, but I do so from a position of humility. I didn't get this right because I didn't have a position in Netflix, nor did I start one. So I'm not really trying to dunk on anyone, but what I'm trying to bring across to the audience is the fact that understanding a company deeply pays off. And now the next section of the analysis is looking at Netflix's next stage. Netflix now promises to meaningfully increase engagement and thus earning power by fostering a one-to-one relationship with users and multiplying the surface area of its intellectual property. Let's get into depth here. In 2022, Netflix also cracked down on password sharing to avoid users piggybacking the accounts of relatives and friends. This has enabled Netflix to go from diffusely addressing everyone in the household to developing a one-to-one relationship with each individual customer, thus vastly expanding optionality. Such a move has the potential to dramatically increase Netflix's earning power over the long run by multiplying the surface area of its intellectual property, just as Disney has done in the past by introducing theme parks. By having a direct communication channel with each end user, Netflix can now deploy additional entertainment verticals at a marginal cost. By expanding the surface area of its intellectual property, Netflix has the potential to non-linearly increase the value of the company. In 2021, Netflix made strides in the gaming industry by acquiring several gaming studios. Gaming provides an avenue for fans to spend much more time interacting with intellectual property and, more importantly, gives way to the creation of communities. Communities generate user-driven content, which brings in additional users at a marginal cost. Thus, gaming not only promises to enable Netflix to increase the average revenue per member, but also to decrease the cost of acquiring new fans, which can then feed back into its traditional show business. This move may have a considerable impact on Netflix's unit economics over the coming decade, with much of its gaming revenue accruing to the bottom line. Much like in the movie business, the gaming industry's greatest cost is acquiring gamers. Certainly, Netflix has the user base to funnel customers into games of its choosing. Still, and most importantly, it can apply its machine, the combination of intellectual property and distribution engines, to grow the gaming business intrinsically. For Netflix, the complexity of applying its flywheel to the gaming space is marginal and accretive to its financials. For competitors, profitably emulating the flywheel becomes exponentially harder. They now have to get it right along two verticals instead of one. The pressure to move towards ads, with the turmoil of building out an ad tech stack, further accentuates the difficulty. Here's a quote from Greg Peters, the co-CEO, during the Q3 2023 earnings call. He said, "We want to really grow our engagement by many multiples of where it is today over the next handful of years." And the above reasons, the reasons that I was talking about, basically the idea of opening a one-to-one direct communication channel with each end user and then multiplying the surface area of the IP, is how I think they're going to do it. Given the similarities of the movie and gaming businesses, I believe that Netflix will succeed in time. In Q4 2023, according to management, Netflix was among the top mobile downloads for a few weeks following the launch of Grand Theft Auto Saga, third-party games, of course, which many of you will be familiarized with, along with some proprietary games like Money Heist and La Casa de Papel. Netflix is off to a great start, and to date, management has demonstrated great discipline in reinvesting back into the business, with steadily rising margins despite an exponential increase in content spend, which I cover in the next section of the deep dive. For now, management claims that investment in games is small, but will grow in line with the business over time. In turn, and this is where I think this thesis is relevant, not just for people wanting to learn about what makes a 400x plus stock, but also about people thinking about making an investment, is that Netflix is still at less than 10% of TV hours, even in its most mature markets. Management estimates that Netflix captures less than 5% of consumer spending in movies, shows, and games. Even at a market cap of $239 billion, as of the time of me writing this deep dive, Netflix has a long runway ahead and can multiply its valuation considerably from here. In turn, as automation kicks in across the economy, I expect its TAM, total addressable market, to get much bigger. Now, onto the financials. My high-level overview of the financials, which I will get into the depth now, is that Netflix started printing cash when it became a global cultural powerhouse. Over the coming decade, its levels of free cash flow per share will broadly track its ability to continue increasing its influence over culture worldwide. Over the long term, stocks broadly track free cash flow per share, so the latter is really what we care about. A look at Netflix's income statement reveals that the company began to print cash shortly after gross margins inflected in 2018. This happened just after Netflix won its first Academy Award in 2017, with the volume of awards steadily increasing in subsequent years. Netflix started producing original content in 2013 and went global in 2016. Per the graph above, one can appreciate how gross margins have been trending since. The company has capitalized on the aforementioned cultural asymmetries that have allowed Netflix to keep increasing its content spend while obtaining better margins. Therefore, the way to gauge Netflix's future cash flow per share is through an in-depth understanding of its ability to influence culture worldwide. The distribution methods and intellectual properties morph over time in ways that are unpredictable. But what truly matters is the total cultural impact on the other side of the equation. Many Netflix investors in 2022 certainly did not think about this, so it's a worthy mental model to explore. In turn, Netflix has been sustainably producing positive cash from operations since 2020, ever since it then began to bring OPEX as a percentage of revenue under 21%, when it had previously come in the 24% range from 2014 to 2019. So it was the cultural asymmetries that increased Netflix's earning power. and in turn, the increased leanness that crystallized it into cash flow production. It's fundamental to observe that without the increased earning power, decreasing OPEX as a percentage of revenue would have made Netflix fall behind with respect to competitors. The fact that it was able to cut costs in relative terms and stay ahead confirms that success is the result of cultural power brought about by producing and distributing originals worldwide. As previously explained, the source of Netflix's cultural relevance is ultimately a more finely tuned intellectual property and distribution machine versus that of competitors. In turn, the shift towards addressing end customers on a one-to-one basis and multiplying the surface area of the intellectual property will make the machine better by increasing user lifetime value and decreasing acquisition costs. In turn, this should equate to expanded cultural power as members spend more time engaging with Netflix's intellectual property and into higher margins. I also expect the company to go beyond gaming and continue increasing the surface area of its intellectual property multidimensionally via the deployment of subsequent verticals. This should ultimately increase free cash flow per share levels over the long term in case of success, which I do assign some high odds of this happening. Further, Netflix can, for some time, mute the effects of the bottom of declining gross margins by cutting costs. Therefore, the most direct measure of Netflix's cultural power is gross margins because they cannot be quite as easily adulterated. Regardless, investors in 2022 had to endure a quarter-over-quarter decline in gross margins from 39.58% in Q3 2023 to 31.18% in Q4 2023. But gross margins then came in at an all-time high of 46.89% in Q1 2024. What this proves, as I've said many times, is that key performance indicators can be quite noisy in the short term from quarter to quarter, and that therefore a qualitative understanding of the business is paramount. It seems natural that even the most excellent companies experience cyclicality in their capacity to innovate and deliver exceptional output, which is why wisdom is as important as intelligence in long-term investing. If one had interpreted the shift towards ads as a sign of weakness, the inclination to sell would have been higher in 2022. If one instead processed the pivot as a way to optimize for scale and strengthen the moat, the inclination would have been less so. It now seems that the former mental path was the right one. To conclude, studying Netflix closely has taught me that one has to understand companies on a first principles basis because eventually the market will test convictions thoroughly. I, of course, already knew this, but this is a particularly insightful case given Netflix's incredible returns to date to shareholders since IPO and just how quickly notable investors capitulated in 2022, with the company then quickly proceeding to bounce back, fundamentally and in terms of their stock price. Further, a year after studying Netflix deeply for the first time, I now see that Greg Peters and Ted Sarandos, the current co-CEOs, are worthy custodians of Netflix and its culture. The company seems to be operating in a fundamentally identical manner to how it operated under Reed Hastings, which means that we can likely expect excellent execution going forward, so long as the culture remains well managed. Further, I see succession as the key enabler of the long-term thesis. So long as Netflix carries on producing more Gregs and Teds, the culture will probably be preserved and enhanced, which is very important over time, and returns will likely ensue. In turn, as folks around the world continue to work less hours per week, the opportunities Netflix will have to entertain the world will multiply over the coming decades. My view is that just at over 7 times sales and a market cap of $241 billion, Netflix has a long runway ahead. Until next time, and thank you very much for joining me. If you enjoyed this deep dive, please, can I ask you one favor? Share this with one friend who you think will also enjoy it. These deep dives are for free, so the only way this grows is with your help. So thank you very much. Take care, and until next time.